extremely thrilled to host today an always topical discussion and a current update with our partners at CIBC Capital Markets. So we chat about the tremendous homegrown innovation making cross-border investing easier than ever for Canadians in Canadian depository receipts. Today, we're going to explore how CDRs work, how they can be incorporated into a modern portfolio, and the power of diversification and more. So stay tuned. Couple of quick housekeeping matters. First, we've got you here roughly 30 minutes today. If you've got any questions, feel free to drop them into the Q&A box and we'll work them into the dialogue. If we don't come to them, don't worry, we'll deal with it at the end. If we don't get to them at all, don't worry, we'll pass your questions on and make sure you get a response back after the webinar is complete. And last but not least, I'm incredibly excited to be joined by two special guests, Steve Gailey, Executive Director of CDRs, and Natalie Chapman, first-time guest on the show, Associate in Global Markets, both from CIBC Capital Markets today. So Steve, Natalie, thank you both for joining me and looking forward to the conversation today.
Thanks for having us.
Happy to be here.
Absolute pleasure. Steve, why don't we start with you, set the stage. Quick refresher for anyone who's been hiding under a rock for the last 2.5 years and hasn't heard about CDRs yet. Why don't you tell us what you and the team have been up to?
Absolutely. Thank you very much, Eric. So as many of you know, CDR is a Canadian exchange traded security, gives Canadians the ability to invest in US equities, but in Canadian dollars and with a built-in currency hedge. So what this means is that CDRs provide investors with an opportunity to decide whether they would like to convert their Canadian dollars into US dollars for those investments in US stock. Our aim in creating the CDR was really to provide a vehicle that simplifies the investment experience for Canadians. There can certainly be a lot of noise when it comes to investing, and especially investing globally outside of our country, with the challenge for the team here being the creation of a security that smooths out the investment process versus complicating it. So what we did was we created the CDR, Canadian Depository Receipts. They have the same look and feel as that of the holding of a US equity. Both the trading and portfolio management experience is similar for many reasons, just with a mitigated currency impact. So they can be purchased or sold on an exchange, the Cboe Canada Exchange actually, and you can purchase through or transact through your investment advisor or your self-directed brokerage of choice, and they are not a synthetic product. And what I mean by that is that CIBC is actually holding the underlying US equities in custodial accounts, and then we issue our CDR receipts against those holdings. And that's how investors are actually eligible to receive similar entitlements through the CDR as a holding in the underlying equity would. And also why returns are so similar as well. So actually, we actually have a simple table here, thank you, that's actually we can refer to that shows how CDRs tick that box for Canadian investors. Reviewing a comparison of the CDR versus a direct holding of the underlying US share, again, we have a number of similarities. So both are exchange listed with a high degree of liquidity, have eligibility to be held in registered accounts, such as your RSP, or ESP, TFSA, and of course, they're subject to the same dividend and voting entitlements as well. So this information can actually be found through the CIBC website, which is cdr.cibc.com, just under our corporate actions page. And taxation as well, it's actually very similar to a holding of the underlying US equity. So what this means is withholding tax would still be applied to dividends, and the T1135 is applicable from a foreign property reporting perspective as well. Now, differences between the two are where we see that value proposition for the CDR come into play. And that includes fractional share ownership, a hedge against currency fluctuations, and all transactions being completed in Canadian dollars. And again, that includes dividends. And those dividends are essentially converted into Canadian dollars upon receipt and then paid out to investors based on the number of CDRs held and our corresponding CDR ratio. So Eric, we've certainly come a far way and have had tremendous support across Canada for the product so far, which we're certainly humbled on. And this support has actually allowed the team to scale up the offering quite quickly, now with 54 names trading across the CDR universe in just a short period of 2.5 years.
It's simply incredible on the journey that the CDR product has been on from kind of its starting point to where it is today. And the three things at the bottom of that list: your fractional share purchase option, the hedge certainly showing its benefit over the duration of time, And, a phrase you guys always like to push out into the ecosystem, you earn money in Canadian dollars, invest using that money into a Canadian product, and you can hold and diversify abroad. On the exchange front, of course, we're extremely proud to have been partners in the creation and listing of those products on our markets, and we're certainly seeing a tremendous increase in growth and trading volumes across the entire CDR platform. So it's been really quite an impressive journey forward. On the note of program growth, you mentioned, Steve, 54 names across the universe now. And I think we've got a slide that we can actually show our audience just on kind of where things are headed. The journey this product set has been on from inception with the first ticker, Amazon rolling out 2.5 years ago, to where we are today with your latest batch making out in market. We're looking at trading activity going on an almost triple from where they were this time last year. And that's really a good indication for investors that there's popularity in the product. More people are buying it, using it as a trading vehicle. And what I really like to see also, and I know it's probably more CIBC's interest from a product perspective, you're seeing that nice directional curve in growth in AUM, which means it's not just being used to trade, it's also being used to invest and hold a security over an extended period of time. And each product you launch, you keep seeing new interest and new investors coming into it quite nicely. Put it into perspective, on the trading side of things, February last year, the platform was turning over on average about 50 million in value on a daily basis through the course of the month. Fast forward to last February, or 3 days ago, the entire month of February 2024, and we're just shy of 180 million in value traded on a daily average basis. So really showing that the power of the product and the increased selection that investors have as a reason why to take a look at CDRs when you're looking at investing abroad. The other thing that I've been really pleased to see is an evolution in spreads. You've kind of seen the first products go and largely being backed by market makers on the street and putting product out to market. But as the product grows in its life cycle and has more interest from investors, you start seeing that spread start to get tightened up so that you've seen kind of this natural shrink of the bid-ask spread narrowing well over time. Few lifetime milestones for the product, which I find just incredibly exciting. Also, I think we hit 27 billion in value traded overall since launch. So it's just turnover every day, and every time you hit an earnings cycle or news in a security or an acquisition, you see that volume moving in the security. And 27 billion is a lot of money moving hands over the course of 2.5 years. Still lots to go, and I'm sure based on the chart in front of you, these are going to keep scaling up. We're over 4 billion in AUM now. It's truly impressive just to watch this go. And yet another milestone. The cool part, you look at the windows between 1 and 2 billion, 2 to 3, it got shorter in time, 3 to 4, even shorter still. So just showing you the pickup, the recognition of the product, and that when we launch something new with our partners, you start seeing that product grow pretty aggressively from day one. So it's not also just really concentrated in 1 or 2 products now. You start looking at the diversity of the lineup. You've got multiple sector coverage. You've got industrials. You've got pipelines and utilities. You've got tech stocks, obviously, automotive and EVs. There's a bunch of different things that are kind of out there for investors to take a look at. And on any given day, you can see any one of those names popping off, whether it's earnings news, misses, or hits. It can also be M&A and acquisitions, other news going on in the business. You look at AI and the impact that's having on an entire sector of companies that may seem intuitive, chip makers, and not intuitive, folks who invest and own those. It starts to get really interesting just watching how investors are reacting to that news cycle along the way. So it's fun. Great watching the product grow, but lots more to go. And these products continue to grow in popularity across investors, their wealth managers and financial advisors, and now seeing some really good adoption into the portfolio manager community as well. So lots moving in the space. Ease of access is certainly the feedback that the team has been receiving on CDR listings. Natalie, maybe a good time to bring you into the conversation and chat a bit more about why Canadian investors are starting to look at adding CDRs to their portfolio, what's the product bringing, and why Canadians might have been missing it up until now.
Yeah, so really good question and comment. And I think that you actually provided a few touch points earlier in your chat that we'll touch on in a minute, because I think it is really relevant to keep in mind when we're considering what are CDRs bringing to the table that people are finding so extremely, enticing and useful. An important shift, though, just to bring it back to basics, an important shift that's occurred within the investment landscape, I think even over the last few years, is we've seen an enormous uptick in portfolio education. When we look over the discussions that are happening with investors across the street in terms of portfolio construction, and also I think a lot of more folks are very aware of the term home bias and the impact that that can have on portfolio performance as a whole. So just as a quick refresher for everyone in the room, equity home bias, it's not new, all right? It's been reported on since the early 1990s. And essentially, the best way to conceive of it is that we buy what we know, right? It's the behavioral tendency of investors to intentionally overweight allocations in their own domestic markets. And that comes, of course, at the expense of foreign holdings. So I want to highlight that, we're talking within a Canadian context. That's an internationally observed phenomena, though. Folks deal with investors across the country, deal with home bias, investors around the world deal with it. Investors simply have a very natural and human tendency to concentrate their investments in their domestic economy, whether that be Canada, Japan, Europe, the US, Australia. It's a very human behavior, and it's really well documented. When we look, however, you've asked, what is it about the CDRs that is really resonating with people, and why does home bias matter at all, right? It matters because for anyone who is investing, you're looking to participate in upside in the markets through a properly diversified portfolio and that participates in global growth. And even just to bring it back even to basics, why do we diversify at all? It's really as simple as reducing risk. You don't want all your eggs to be in one basket. And if we look at the performance you can see on the slide here of global indices like the MSCI World, it becomes clear as to why diversifying into equities outside of just, for example, the TSX 60, one's home market, can be a great performance enhancing strategy, right? So going just outside of Canada as a whole can be an important tool in the toolkit for the Canadian investor versus simply limiting ourselves and our exposure solely to that domestic market that we know and love. Part of the challenge, obviously, that we have here in Canada, and this can show up, and we'll take it more granular to Canadian investment portfolios now. Some of the challenges that can show up in Canadian investment portfolios is we do live just north of the largest economic player in the world by market cap. And it can be very easy for us as Canadians to forget, where does the Canadian economy sit relative to the global picture, given how close we are to that, that superpower US economy. Just to provide a quick snapshot and a refresh. As of the beginning of 2024, Canada is sitting at 2.8% of global market cap, whereas the US is at 44.9%, almost 45%. So, doing really, really well. Obviously, we all saw what happened with the Magnificent Seven just before the holidays. We've seen what's happened with the tech names that have exploded over the last few months. The reality is that the US eclipses the next largest geography, which would be the European Union, which sits at 11.4%. So the reality is that the US equity markets simply are the largest in the world. And that's why it makes a lot of sense for us to provide access to that global diversification through the CDR. And if we go to the next slide really quickly, we can drill down and take it back to your comment earlier about those different sectors, right? And the value add of that sector diversification. So sector diversification is a comment that, you guys have been getting. It's a comment that we've been hearing a lot lately from folks who are using the CDRs. When we look at diversification and that home bias question, a really good proxy for diversity within a domestic economy is, of course, the reference index of that economy. So for us, it would be the TSX 60. For the US, it would be the S&P 500. If we look at the TSX 60 and you look at the sector breakdown that is showing right here, it's interesting because the top 10 holdings of the TSX 60 represent 44.8, so almost half of the index itself. And if we look at that sector diversification, you can see very clearly, and this should come as no surprise to any of us on the line, a typical sector comparison would show us that Canada is typically overweight in energy and financials. A lot of those great names. As a banker, I'm obviously a little bit biased and happy about the strength of Canadian financials. However, it does leave us in an economy that's significantly underweight in sectors like, you mentioned, information, right, technology, and healthcare. So those are extremely important sectors when you look at global market cap, at expansion. We talked about AI. You're looking at how technology is becoming more and more prevalent, not just within the sector of communications, the communication space, but also in terms of looking at what's happening within the industrial sector, what's happening within construction and healthcare. This kind of the tentacles of the IT expansion and the importance of tech is really being felt by every different sector. So again, no surprise that when we look at the S&P 500, for example, you've got 30% of the index is composed of information technology. You've got 13% of healthcare. You also have an important discrepancy in the communication services space where 9% communication services. And I know we're talking about this in percentage terms, but also if we flip it into relative terms, remember that a universe of 500 companies is significantly larger than a universe of 60, right? So within those percentage points, you're also getting a lot more names in that space. So when we look at this and we take it all as a whole, we really can see the value add of that foreign equity exposure that can come in handy to offer exposures to sectors that we may not necessarily traditionally have as much access to within the Canadian economy. And so that becomes, I think, it's part of the reason that you mentioned those gaps between AUM growth have shortened. I think as people realize that this tool is in the toolkit now, it helps to mitigate that home bias. It helps to provide ease and access in a way that we haven't typically seen before.
Well, it's a great segue, Natalie. Like we know all the good reasons why investors look outside Canada to diversify their portfolios, beyond banks, beyond energy, and now looking at tech and healthcare trends south of the border and want to be a part of that investment thesis. But then, good kind of line of questioning: why should an investor consider using a CDR over a direct investment into US or potentially another global equity in the first place?
It's a really good question, and it's certainly one that we've been asked a lot during this process. Like, what's the value add? So I think if you take it back to basics, there's some really common sense reasons why investors are staying within Canada. Obviously, there are many reasons a Canadian investor would want to maintain exposure to Canadian equities, whether that's the natural human bias towards what we know, familiar names, major dividend players. I mentioned earlier the banks, insurance cos, all this stuff. We also have a tax advantage. And then the most important one that I'm hearing, at least, is the ease of transacting in Canadian dollars, right? We've talked about managing home bias, how that can be an issue for the Canadian investor. That seems to be, in our conversations, the main barrier that we've had in accessing global markets is through our Canadian dollar. I think Canadians across the street also recognize, okay, why, when they're faced with an opportunity to access U.S. market, the U.S. Listed names that we're discussing through a Canadian dollar, they are also recognizing that there hasn't traditionally been a simple 1, 2, 3 solve, right? So, and that's the heart of why CDRs are different, right? It's that ease of access. We've built out a pathway where investors can made it as simple as one, you check the list, you confirm the ticker, you plug it into your order system, then you click buy, and now there's a US listed large mega cap name incorporated into your portfolio. That is a big name in tech, healthcare, communication, services, consumer discretionary, all in Canadian dollars in your portfolio.
That's a good point, Natalie. And
Yeah.
I guess like comparing that approach to like, the more traditional approach of when you're going to deal with currency conversions and fees, I know like as Canadians, we're typically earn our income in Canadian dollars. And to purchase that US stock, of course, you need to convert into American dollars in that initial step in your purchase process. And as we know, every FX conversion has a cost. And depending on the size of the conversion, you have that economy of scale. You'll get a better or worse price. With typical transactions for investors, well, like I guess the three of us here, you're typically seeing a fee of up to 2%. And then we have the CDR, which really gives us a way to skip that initial conversion and pass on savings to our investors, while also removing steps and quite a bit of math as well from that basic stock purchase transaction. Now, an item I thought worth mentioning as well as we're approaching tax time, CDRs actually have an indirect cost savings as well through keeping our investments in Canadian dollars. And with our portfolio and tax reporting kept in our home dollar, It's actually much simpler for end of year reviews where you may have to consider the FX conversion costs associated with buying your US equities or equities outside of Canada. And actually, as a new father, I recently recognized that in Canada, our ESPs are actually limited to holding only Canadian dollar accounts. Although we can transact in US equities, each buy and sell will have an FX charge attached to that order. So if you're aiming to get US equity exposure in that type of account, CDRs are product positioned quite nicely to really satisfy that need. Speaking of trading quickly here, I always like to take a quick note here and quick moment here, and let's really cover that quote and trade experience with CDRs. I actually often get the question as to whether only CIBC clients can transact in CDRs, and of course the answer is that as a security listed on the Cboe exchange, all brokerages should have access to trade. So I'm using Tesla in this example, as is the highest volume traded name in the CDR universe, and as actually one of the initial securities that we listed. So using CIBC Investors Edge as our example, simply head to the trading stocks section of your brokerage website, plug in either the name of the company or the stock symbol you're looking to buy and sell, select the security that is the Canadian flag beside it, of course, and follow the rest of the process as you typically would. So similar to ETFs, we do actually suggest to transact with limit orders where you select your price. And this is to simply ensure that our market makers are actually able to react to large orders and you're receiving that fill that you expect.
Yeah, definitely the limit orders, especially given some of the larger orders we've seen coming through. It's always good to know that we are able to react immediately to those. And again, this is part of the job of being the market maker, right? So when we look at Steve, just to jump in really quickly, you're showing Tesla in the example here, but I do want to walk us through the other names, right, to give the folks an idea. We mentioned 44 listings. I think it's good for everyone to get a visual. We have 54 mega and large cap names in the universe as of right now, live trading. If you look to the list on your right, you'll notice the Canadian exchange symbols we have in the market are very similar or sometimes identical to their US counterparts. And as Stephen mentioned, you're going to want to click the name with the Canadian flag beside it. The names that we've added to the program, and I think this is important for everyone in the room to know, they're all highly recognizable companies, right? Recognizable companies. You've probably already heard of them. You may already hold them. But as we've expanded the universe over the past few years, these names came from the input and conversations that we've had with retail investors and investment advisors across the country. And half of our new names have very high price per share points of sales. So just to give you an idea, you look at Broadcom trading over $1,000 per share. Again, this has been very tactical in order to show, make sure that folks understand that we are able to provide access to names that may not necessarily have been accessible to in all account types and all size trades. Again, really that question of access and ease. And it shows the interest that we have had in the CDR method of driving that per share price lower through our ratios that we use. And just to give you I think Steve, actually, you should probably speak to this.
Yeah, sure. Actually, I wouldn't mind taking a moment here to look at the 7 new names that we actually listed just as recent as February 15th. So these new additions, certainly well-known U.S. companies, and these very much came from requests directly from our investor, so do-it-yourself investor and portfolio manager, investment advisor audience across Canada. So let's review. So we have Deere, so ticker for the CDR is DEER, known formerly as Deere & Company. Of course, we all know it as a company that manufactures agricultural, construction, other heavy equipment. Those of us that live in the big city may be more familiar with the trucker hats with the John Deere logo. Constellation Brands, STZ is the ticker for the CDR side, leading international producer, marketer of beer, wine, and spirits, and known for brands like Corona and Modelo. BlackRock, very familiar name there. World's largest asset manager, offers a wide range of investment products to institutional and retail and clients across the world. We have Lululemon, most Canadians certainly familiar with the company with its West Coast roots, designer and retailer of athletic apparel for women and men. Certainly seeing it on the trading floor, you're seeing the Lululemon pants more often. And ServiceNow, it's a cloud computing company that provides digital workflow solutions. Palo Alto Networks, it's a cybersecurity solutions company, and of course Thermo Fisher, which is another healthcare name to provide more diversification opportunities for Canadian investors, and that company is focused on medical and scientific devices.
Wonderful. That's a nice group, and seeing good coverage across a number of names in each of the sectors, and starting to give investors some real choice. Actually, I want to work one question in from the audience, and maybe Steve, best for you. Looking at expanding the CDR portfolio, one, what's on your radar next? And the question specifically from the audience around Europe and Asia. I know you've kind of hinted at global plans previously, but it's maybe been a little while. Anything you can share with the audience today, or mum's the word for the moment?
No, yeah, absolutely. We can certainly share. We're typically looking to continue to grow out the U.S. iteration of the offering that we have currently launched. 54 names. Hopefully, we'll see at least 55 around the corner. So yeah, certainly keep those requests coming. Make sure you're keeping Eric's inbox nice and busy with your requested tickers. We're all ears. As you'd imagine, when we have 50 plus names already in our universe, you can be a little bit more nitpicky. So a little bit of feedback goes a far way. And then in terms of outside of North America, we do continue to think that's a natural evolution of what we've built here. It's certainly much more of a complicated solve. I think time zones is one thing that we're able to benefit from with the overlapping of Canada and US and our time zones and trading time zones. It's a little bit simpler to create a product there. So, but again, yeah, certainly keep an eye out for the next iterations of the products. We continue to tinker away in the lab, and hopefully we get something out by the end of the year.
I love it. Thanks for the update, Steve. One of the things I think investors may often notice or perhaps observe, the number of names that you have being added, their U.S. counterparts trade at a much higher price per share. And I know we were talking about fractional share purchase capabilities earlier in the presentation, and you look at BlackRock or ServiceNow, $800 US a share to purchase an entire share from a Canadian perspective. Raises a good question. How are you and the team coming up with that list of names to launch next? Is it strictly based on price point, size of business? What's driving some of that conversation aside from my inbox?
Yeah, absolutely. So and you're certainly correct. Great points. When really either do-it-yourself investors or investment advisors are building a stock portfolio, I think the higher per share price is something that's being highlighted quite a bit recently. You can certainly see that with with this past launch of names. We certainly have that limitation. We have a trade-off between preferred stock weightings and the amount of dollars you have in your portfolio. And that's why that fractional share item is important. So this isn't a limitation based on your income as well. Though some accounts we have, like a TFSA or that RESP I mentioned, we're limited based on the annual contributions we're able to add to those accounts. So an investor may want to add exposure to a name like BlackRock or ServiceNow, but looking at a stock trading over $1,000 Canadian per share, this may not make sense when determining what stocks to purchase. And especially when you have $2,500 or $6,000 in annual contributions to work with. That's pretty difficult math, and you're certainly looking at very high exposure to or high weighting to a stock that may not be your intention. So at the initial launch for CDRs, we're listing actually around $20 a share. And how we do that is we actually adjust our CDR ratio to less than 1. Which means an investment in a CDR equates to a fractional investment in the underlying stock. Pretty straightforward there. So that $20 price point is significantly lower when compared to the US counterpart. And you can see based on the recent increase in volumes that you covered there, Eric, how Canadians are quickly adopting the CDR to fill those gaps in their portfolios. And as our intention is to track the underlying equity as closely as possible, the CDR has been recognized as a security that is an easier fit with many more similarities than differences to the US stock we're accustomed to investing in. So especially when it comes to this recent launch, many professional portfolio managers across Canada, they're actually now using that product to ensure that they're able to execute one equity portfolio across all the range of their clients' accounts. So be the registered accounts with lower contributions on an annual basis or otherwise.
in effect, you're able to be a lot more precise with a CDR product because you're able to get right down to a very good fractional share number to fit into a portfolio.
Exactly, yeah, and we actually highlighted a quick example here. So let's look here. So we actually compared the top 10 weighted U.S. stocks in the S&P 500. So we have the U.S. share format in one hand versus the CDR share format. So looking at a portfolio comprised of one share each of these 10 companies. And let's see how the math checks out. So these numbers were pulled last week, by the way, and let's remove the impact of paying stock or FX conversion commissions from the equation as well. So firstly, looking at our US equity portfolio, converted into Canadian dollar terms, we're impacted quite a bit by a handful of names trading at a high price point. So out of those top 10 names in the States, we have Broadcom, NVIDIA, and Eli Lilly, all trading above $1,000 Canadian per share. So this portfolio, it adds up to about $4,800 US or $6,500 Canadian. Meanwhile, shifting over to the CDR portfolio, exact same set of names, one unit of CDR each. In that CDR format, we're able to construct a portfolio with similar exposure at a much lower price point. So about just over $300 in total. So I'm often asked actually like how simple it is to transact in large notional size with CDRs, and my response is very similar to what you would hear relative to ETFs. CDRs have similar ETF market makers again that ensure liquidity in each CDR and is similar to that of the underlying US equity. If we're able to buy or sell the same US stock in large volume, use your limit orders again, and you should have no issue transacting in that same dollar amount for the CDR. What we've definitely seen over the past current year is a strong preference to really have the option to be more selective in stock picking as well, and we've certainly seen that in the performance of the S&P 500 in 2023 and year to date as well. Just a quick mention actually to active traders, because we typically have a few folks tuning in. And active traders, of course, those investors looking to profit from near-term increases in value. What we have here in the CDR format is really another option in your toolbox, and that really allows you to decide whether it's necessary to convert your currency prior to purchasing, of course, which we've covered, but also whether you would like to roll the dice on movement in the US dollar for a short-term trade.
Maybe while we're on the topic of share price and the underlying, maybe a good time to weave in two quick questions. We've just gone through a split with Walmart in the US. Talk about the mechanics, what ratios moved, how did it all kind of come together for CDR investors in particular?
Yeah, absolutely. I can take that one. And I think we have a hedging question that I think Natalie can cover after that. How about that?
Game on.
Hedging is a little bit more complicated. So, yeah. So when it comes to splits, Walmart, it's I think this is the fourth or fifth split that we've processed since inception of the CDR program. So, what's really unique is we actually have our CDR ratio. It's a dynamic ratio, so it actually allows us to provide. It gives us two options really, and those two options are to follow suit from the underlying U.S. equity and essentially just split the CDR. I think Walmart was a 3-to-1 split. So we could shave off or relist the Walmart CDR at a third of the price, or what we can do is actually adjust the ratio behind the scenes as well. So based on where Walmart's trading right now, in the CDR format, we're comfortable with the listed price still fairly low and easy to access. So we decided to adjust that ratio behind the scenes. So in what you ultimately see there is Walmart CDR is theoretically worth a little bit more of the underlying US counterpart.
Super. And maybe one more while we're on the topic of kind of corporate action events and things going on with the underlying company itself. You know, if a US company gets acquired, I think we've seen one or two examples of that over the course of the CDR lifecycle, and a few names. Microsoft comes to mind. What happens with the CDR itself? How should an investor think about that event from a Canadian perspective?
So if the CDR company that's listed is acquired,
or if they make an acquisition, something else happening underneath the covers, what's kind of the methodology? How should an investor think about it?
Yeah, it's a good question. So you would expect if the CDR that's listed isn't exactly changing its makeup, maybe that's the acquiree, so it's acquiring another publicly listed company, then you would expect the same price movement to be reflected in the CDR itself. In the event of a corporate action, maybe we have a spin-off, so of a CDR listed company. In that instance, we would really look at each scenario in a specific manner, but we certainly have a number of different approaches we can take. If we are not open to maybe listing that additional spun-off company in CDR format, and there's a number of factors that we typically look into to make that decision, we would have the option to essentially just liquidate the additional shares and maybe process through a special dividend or a process like that. Yeah.
So I would let the investor kind of take the cash, run off and buy the underlying security directly in the US themselves if you weren't coming out with a CDR then.
Get a new car, whatever you'd like to do with that cash.
I love it. Then Natalie, over to you. Let's talk about the hedge because we got a few questions on it, but I want you to set the stage on where that's headed because that's kind of the last big feature inside the CDR vehicle that's absolutely needing to be covered.
Yeah, absolutely. So just to provide a little bit of background, I think you mentioned at the very top of the hour the tagline about owning the company. So folks may have on the line may have heard the tagline "own the company, not the currency." So let's kind of delve into what that means on a practical basis. One of the key features of the CDR is that currency hedging. So for a fee, and that fee is capped at 50 basis points per year, the CDRs mitigate the impact of any fluctuations between the US dollar and the Canadian dollar. So this feature is particularly powerful as what it allows for is the investor to focus on the performance of the stock itself rather than worry about potential losses or gains due to the currency movement. So it essentially keeps you currency agnostic. You're focused in CAD, you're agnostic to what happens with the USD. We're essentially presenting through this vehicle Canada's very first single stock currency hedge security. And what that means is, again, you've got more accessibility, more flexibility for Canadian investors, and you have a choice, right? Before CDRs came along to market, the simplest approach to getting a hedged US dollar exposure would have been through the use of ETFs, right? Your currency hedge index ETFs. Now there are many versions of those ETFs available and they have currency hedge counterparts. And there is certainly value in passive index investing, like we're not questioning that. But what we have seen is especially high levels of interest who are looking to be more selective in that name selection when they are approaching their equity investments. It's proven to be a good approach. I mentioned Magnificent Seven earlier. You look at the very few names, only a limited handful of names driving the bulk of returns in the S&P 500 in 2023. We're talking about the AI 5 now in the news quite frequently over the last few months. It has been, traditionally you have not had like a US dollar agnostic option for selecting those single stock names. So for cases where you have a sensitivity to portfolio swings on monthly statements, it can often be a positive to dampen the volatility where possible. And part of that volatility in a cross-border portfolio can, of course, come from that difference in currency and any interest rate differentials related to that. So to give a more technical answer, because I can see it in the chat, how often is the currency hedge adjusted? The CDR ratio is automatically adjusted on a daily basis to account for the notional currency hedge. And just for those in the room who are really technical and would like to understand the mechanics of it, in terms of the actual mechanics, we are simply rolling daily FX forwards and we manage the process so there's nothing for investors to worry about. And it's honestly, the process itself is quite similar to currency hedged ETFs. Currency hedge ETFs will typically roll monthly FX forwards. We are rolling daily FX forwards on the notional of the program. So there is, we talked about opportunities of executing at scale, right? If we're hedging at 4 billion as an institutional market maker, we have those economies of scale that we can then pass on to the end investor rather than someone managing and hedging their own US dollar exposure. And managing those daily forward contracts makes our tracking also far more effective because, again, you're hedging on a daily basis rather than a monthly or quarterly basis, and you're doing it at those institutional rates. So again, it can be really positive. And in terms of, okay, do I want to be hedged? Do I not want to be hedged? That's a decision that investors are going to make themselves. And for us, I mean, whether it's discussions in my day-to-day or even talking to friends and family outside of the trading floor, I'm hearing a lot of different approaches on how they're using the hedge product, on how to use a hedge product. Some investors, and Gilly mentioned this earlier, and Stephen was talking about active investors who have a specific outlook on currencies. Some folks are using the CDR to take a more tactical approach to their FX management as a combination strategy. We also have a growing number of advisors and investors who've been using the product to remove the FX guesswork from the equation entirely, because again, we know currency markets are very complex, massive beasts. Not everybody is an FX expert. I wouldn't consider myself one. And sometimes it's simply easier to manage, either remove that question entirely. And for those who want to actively manage their FX outlook, they now have another tool. But again, it comes back to giving people the option to own the name and not the currency. And I think that the massive uptake we've seen across portfolio managers, investment advisors, retail investors, is proof that that CDR really is filling the gap in the toolkit for the Canadian investor.
Super. Thank you, Natalie. It's been simply incredible to watch. And, for investors that have their screens in front of them, you can pull up your charts, pull up the US one, pull up the Canadian one, and you'll see at a high level, things are matching up ultimately between both markets. And that's really the hedge at work, creating the same line graph front to back on a trading day and over time.
Yeah, for sure.
Related question, something that I'm not sure that we've actually had the joy of experiencing yet, but if an underlying security in CDRs actually gets halted because of news or something else going on in its original listing marketplace, in this case, a US name, would the related CDR also be halted in Canada?
Yeah, I can take that one. Yeah, so you would expect. Sorry, Natalie. Yeah,
no, go ahead.
You can do the next one. Yeah, so you can expect the CDR market to I guess more or less mimic what you'd see in the U.S. underlying. What's interesting as well is IROC, the main regulator in the markets in Canada. They actually, I think last year, released single stock circuit breakers related to CDRs. So not just a halt, but if you're seeing significant swings in a stock in a very short period of time, similar to what you'd have seen a stock or an ETF, CDRs would typically be temporarily halted as well in those scenarios too. So you certainly have the protections there.
Super. Thank you. And Natalie, maybe the second one back to you on, you're trading a Canadian listed vehicle, Canadian dollars, it's underlying securities to US. Most holidays we get to enjoy together, but there are a handful that are off kilter with US markets for some reason or another. I still don't know the answer to those questions to myself, but can a CDR still be traded on a US holiday, but not a Canadian?
Yeah, so that's a really good question. So the short answer is yes, but so generally CDRs are tradable on every Toronto business day, and that ordinary trading would be scheduled on for the Cboe exchange, right? So there is greater liquidity risk whenever the primary trading market is for the relevant underlying reference share is not scheduled to be open. So that's something I will flag. Days that are US holidays that are not holidays in Canada, your liquidity is going to become a question. Liquidity, obviously, that's just the ability to sell an asset for cash at a fair price. Some securities are going to be, again, impacted by if you're looking at your reference share and it's not trading live, pricing can also be impacted when you're not seeing that trading in the US. That's something that, again, that liquidity risk may impact the market value of the CDR directly or of the underlying share. There may be a little bit of a spread. You'll see a gap widening. This is something where we say, you want to trade with those limit orders. Again, if you're targeting a fill at a specific level and it is a holiday, you really do want to make sure that you're putting in that limit order to making sure you're getting your fill, even if there might be a slight gap, again, related to the difference in trading activity between the CDR and the underlying shares, which may become slightly less liquid due to changes in market conditions. And again, this would be something that we'd want to make sure people, like anything else, right? You just want to be putting your limit orders in, be very careful. And if it's a US holiday, you might as well take a holiday yourself, right? So.
And this is the same counsel ultimately that capital markets professionals would give for ETFs. Also, when your underlying market is closed, be conscious of big movements or big trades into securities.
Exactly.
So the key point is your underlying market is closed. Liquidity is not there to be created. So you're left with whoever wants to trade that name on a day where the Canadian market is open.
Yeah, so just be careful.
Absolutely. Now, time flies. We were expecting to keep our audience on for 30. We've held them for an extra 15. So I know there are 2 extra questions in the inbox. We will come back to you on those. But I'm going to suggest for now we close off today's webinar. And Natalie and Steve, obviously, really appreciate your time and insights this afternoon. We're inviting all of our audience today and our investors. You got a lot of resources available at your disposal. You got the CIBC website newly refreshed. Looks great, by the way. I know you've got some real-time data sourced from all the markets up on pages now. All the information about corporate actions, your ability to vote, ultimately resources, FAQs, things that we talk about on these webinars frequently and often. They're all there at your disposal. You can always email us as well, cdr.info@cibc.com. Separately, there's a bunch of pages on the Cboe Canada website that'll give you depth of book quotes and a bunch of other information maybe after if you don't want to log into your investment platform and take a look while you're on the move. So separate from that, lots of resources available. Don't hesitate to ask. You've got Natalie, you've got Stephen, you've got our social media accounts. Reach out, ask questions. We're very happy to engage and certainly would love to take new inbound requests on what CDRs you as investors and advisors would like to see next. So Steve, Natalie, thank you very much for joining me. To our audience, thank you for joining us for an extended session this afternoon. We hope you came away with a good update on everything going on in the land of CDRs, and we're looking forward to having you all back soon enough with the next update and rollout and launches surely to follow. So with that, this is Cboe Canada signing off from today's Spotlight with CIBC. Natalie and Stephen, thank you so much. We'll see you soon.